Hello there. My name's Gareth Payne and I work in the distressed and special situations team at Pictet Asset Management. And over the next few minutes, I just want to talk about this very interesting time in markets, particularly in the distressed space, and just set out a little bit of what we're thinking and what we're seeing in the space at the moment. There were a lot of red flags and signals that we were seeing even towards the end of 2019 and into 2020, such as the rise of covenant-light loans, the number of zombie companies out there that were not covering their interest payments with their earnings, the aggressive accounting strategies such as earnings add-backs and adjustments that we were seeing, and also the general leverage levels that had crept up in the market to levels that were similar to that of the great financial crisis. Now, of course, COVID did hit in March, and we did see a real spike in distress levels. So approaching 40% of the European high yield market and around slightly less in the US of bonds trading at distress levels. That is to say, trading at a spread of over 1,000 basis points or at a price of sub 80 cents on the dollar. This has since fallen away in the face of unprecedented liquidity from central banks. However, there is still a lot of lingering effects from this that we think will continue to create opportunities in coming quarters. As the fundamental outlook declines for many companies and their ability to generate profits declines, they have been downgraded by the ratings agencies. And one clear example of this is the increase of CCC rated companies in Europe and the US, the lowest rating within credit ratings. And that to us, again, is a sign that there is more distress and more dislocation to come. And what about the next step from downgrades? Downgrades are a very clear leading indicator. They correlate very highly with defaults, with corporate credit defaults and credit events such as restructurings that will follow from that. And we have already seen a material increase in defaults in the US, and we're starting to see defaults creeping up in Europe. We think that there are more of these to come, and Moody's and the other ratings agencies, general expectations are for close to double-digit defaults in the coming cycle. And again, this creates a very strong opportunity set for a distressed and special situation strategy. On the other side of the coin, it's important to recognize the fact that we have seen an unprecedented amount of central bank liquidity being injected into markets. This has had a lot of effects in terms of distorting the market. And ultimately, what we think is that this will only go on to prolong the distress cycle and to prolong the default cycle and the pain for many corporates. This injection of liquidity can't solve the liquidity and solvency problems for many issuers. But it's definitely something that we're bearing in mind and something that's clearly having a huge impact in terms of risk sentiment in markets. So where does that leave us? Well, as I said before, we came into this crisis with quite a lot of fragility already under the surface in credit markets. And really what the COVID crisis has done is exacerbated a lot of these cracks and a lot of this fragility for many companies and for many balance sheets. This aggressive accounting standards that we saw and all of the other red flags that we saw are still not going to go away. And in many cases, such as leverage, in fact, companies are going to emerge from this crisis with more leverage than they already had. And in that respect, we think that this unprecedented liquidity injection and these huge numbers in terms of easing and accommodative policy will actually just go on to prolong this distress cycle. And the upshot of this is that for distressed and special situation strategies, this is a very, very exciting time because there's going to be a lot of opportunities to generate alpha, a lot of opportunities in terms of exploring for performance for our investors in the coming quarters and into next year. And if you would like to receive any more information or learn more about this strategy, please do visit our website at